Hi, Mike.
Hi, Liam.
Look, some tough talk from the US Fed at Jackson Hole. We've seen markets correct and some concerns about inflation being a lot stickier than we'd hoped. I guess none of this is hugely surprising to you. We've talked about sort of a second wave.
Yeah, not surprising to me, but I think obviously clearly quite surprising to the market. I mean, Powell's, I guess, kind of known already for sort of his ability to kind of pivot. He's done that twice in his tenure as Fed chairman. So I think the market was expecting him to say that, well, we know inflation's probably peaked, and if it has peaked, then we expect, interest rate rises to be coming to an end. Whereas he actually said the opposite to that, as he said that all his rhetoric was very strong, very hawkish, that we want to get on top of inflation. We don't mind now if we see a weaker economy. We don't mind if unemployment ticks up. So that is quite different to the messaging that's come through earlier in the year. So, yep, second wave, this time still tied, though, to the same problem, which is inflation.
Sure. Do you think the idea was that they were concerned at the Fed that markets had got too comfortable? We'd seen the yield curves pricing in peaks for interest rates and talking about, mortgage rates coming down again next year. I mean, were we just getting a bit comfortable that it was all under control?
Yeah, I think so. I'd say probably the last thing he wanted was the markets to rally post Jackson Hole. So he was in some ways trying to talk the markets down because, if you think about it, is that we've got inflation running between sort of 8 and 10%. We've got interest rates that have been jacked up quite quickly, yet we had at that point an S&P 500 that was only on the off sort of, a couple of hundred points from the all-time high. So that just didn't quite feel right.
Yeah.
So I think he probably said the right thing.
So, yeah, and some success in the sense that there's been an orderly correction across a few days. I guess it would have been a surprise, at least from the way we've seen it over the last few months, if the market had just gone back into bull territory and a straight line recovery from here. It's always looked like it's going to be a bit tougher than that.
Definitely. I mean, the reason why we had the big bull recovery out of COVID was because we had very stimulatory situation. We had monetary policy with rates at zero and quantitative easing, and then we had fiscal stimulus as well. So we don't have any of those right now. In fact, we've got the opposite. So you would expect that markets would continue to kind of sell off into the year end. I suppose part of the reason why they're not significantly lower is that, the consumer is holding up. We're sort of not really tipping into a recession as fast as perhaps we thought.
Sure, it does take a while. These are blunt instruments, the monetary policy tools, for those higher interest rates to flow through to most consumers, though, right? So we've got, in New Zealand, for example, 1 and 2 year fixeds coming off. People will be starting to feel more coming out of their pockets over the coming months.
That's right. I mean, rates have only really been at that sort of between 5 and 6% for 1 and 2 year mortgages for a couple of months. So that's only affected probably a small percentage of the population. As time goes on, perhaps we get towards Christmas and into the early new year, there will be more and more households feeling the pinch of how am I going to find this extra money to pay the mortgage.
Yeah, I mean, in the housing market, I guess we see it at the front end with new home purchases, but, that's already off by, 8-9%. The economists are expecting to see a bit more. Do you think it's got further to go?
Yeah, I mean, the implication is that house prices will fall further. But I think they'll still be well above where they were during COVID. So it's a correction from a market that was too hot and got too inflated. So it's not surprising, and I think overall it's probably good for New Zealand in general to have a sort of a period of weakness in property prices.
Sure. So when we look out, it does put a bit more downward pressure on the economy, probably consumer spending. How do you see that sort of correlating or flowing through to share markets over coming months? I mean, more volatility, or do you think we can sort of find a new bottom and keep on with the recovery?
Do we make new lows, I guess?
Yeah.
Look, I think it's been really hard for the market to hold up with, sort of the weight of data that's coming against it in the coming months. Economies and earnings are probably going to continue to slow down. Yes, it's held up, but as we talked about, there's a lag effect, so you'll start to see that coming through in earnings. That's not positive for stocks. As Powell has indicated, he's not going to change his stance anytime soon, so that means rates are going to be high. Maybe the market starts to price in if we do get if they think there's going to be a recession, that there will be a sort of a pivot next year. But probably, the market would need to head lower before there's a time when actually central banks go, well, you know what, the economy's slowing, unemployment's ticking up, maybe now's the time to ease off.
Yeah, there's going to be an awful lot of debate about recession and how we call it and how deep it is. But essentially, we are talking about a slowdown, a downturn across the next year, however it gets marked, I guess, by the economists.
Yeah, I think this would be a point for investors to be very cautious for the next couple of months, for sure.
Okay, just finally, Mike, so we are still watching and waiting on some of those big inflation numbers, right? There's a lot of uncertainty still in commodity markets. Oil's still very volatile. Yeah. Some good signs. I mean, what are you seeing there, and what do you hope to see in the coming months?
Well, sort of just when you think that we might get a bit of a let-up in terms of oil prices, I saw yesterday that there was some speculation that some of the OPEC producers might come offline. Now they say they will be okay. That creates uncertainty. The massive drought that we're seeing in China is probably not going to be good for food prices and wheat. And if there's, this climate change, which we were just discussing before, is going to likely have a longer-term impact on those commodity prices, which ultimately will continue to lead to sort of sticky inflation for quite some time. So to get inflation back under 2% is going to be quite a challenge, and it may require the Reserve banks or central banks to actually have their target rate above inflation, and that could be quite painful.
So I guess that could mean potentially a longer period of higher rates for all of us.
Yeah, and unfortunately that's what's going to be needed to bring inflation down.
Thanks, Mike. Look, on that sober note, we'll leave it there. Cheers.
Thanks.